March 21st, 2024. I consider these days kind of don't lose days if you're going to trade on stop orders. If you're a limit order trader, you probably really like days like this. But generally, for someone like me, I'm just trying to make money on stop order trades and be very profitable with that before I start trying to trade on limit orders because that's a lot more difficult to do. So I think that days like these are, if you're a stop order trader, this is a don't lose type of day. The market sometimes will do this and it'll go kind of sideways to down or sideways to whatever all day. And you have to find a way to just be flat most of the day and be okay with that because it's not the type of day where you're going to make a lot of money for the most part. But that being said, we did have a wedge today. I looked at it as more of a triangle, but it's kind of a similar thing. You can see we were actually getting lower highs here. So this high, and that high were all lower highs, and we had higher lows as well. And when you're getting higher lows and lower highs, it's a triangle. So what I viewed this as was essentially a triangle. This doesn't want to work. Obviously an overshoot here, but a triangle, and we tried to get a breakout to the upside at the apex, which is generally around a 50-50 chance of it working. And you can see we ended up failing and we got a reversal down. When we got the reversal down, you got to look generally for a measured move down of the wedge or of the triangle. And the measured move down of the triangle brings us right to yesterday's high, which is a magnet. So I actually thought it was pretty likely that we were going to get to the magnet. We didn't end up doing it today. We probably will tomorrow, but I just thought that was interesting, and I thought it was likely that we were going to get to that high. Big gap up, a bear bar closing near its low on bar one. When you get a big gap up, 80% chance you're going to get some sort of reversal attempt on the open. Bar one, it's a good bear bar, but I wouldn't want to sell below it. There's only really a 20-30% chance that if it starts to sell off, you're going to get a big move down. And I would just rather not do that. You get an inside bar on bar two, so it's a high one buy above two. Think of the gap up as a big bull bar. So big bull bar and then a high one buy bar two. It's lower probability. You're pretty much betting that one is the low of the day if you're buying above two. And what do you do when you see three? Well, three is pretty disappointing. You can see bulls not quite able to make 5 points. So they were short of making 5 points by one tick. Needs to go 5.5 points past the high of the bar for you to make 5 points because your entry price is going to be one tick past here because you're buying above, and it has to go one tick past your limit order in order to fill generally. So bull's not able to make 5 points buying above two. Disappointment three. If you bought above two, you wanted a big bull bar on three. You didn't get it. So what's happening on four? As we started to trade back up, traders just took a 1 or a 2 point scalp and sold out, and that caused all this selling. However, down here, you're more likely to find buyers below this low than a ton of sellers. So four wasn't super likely to have really good follow through, and you ended up getting a bull bar on five. So now it's a high two buy, and you have a high one and then a high two. So a high two on the open, which is a pretty common pattern. I actually want to add to my traps trap because there was a 5 point trap on that. So anyways, high twos, low twos on the open. This was today. You can see earlier we got a high two a few days ago. This high two leads to the low of the day. If you're buying today, you were looking for something like this. I would say probably 40% chance that it was the low of the day today. High two here. I suppose you could argue this was a failed high two, but I just put it in the successful one since you were able to make a trade off of it. But high two on the open, I thought maybe 40% chance that bar five was the low of the day. And it's one of those trades where it's probably going to try and trap you out. So it's better to just, if you're buying above five, just sit on your hands and go for, 2, 3, whatever times your risk. I picked 4 times my risk. I bought above five. I got greedy. I put a ordered exit somewhere up here, and I ended up getting out during 13 with a small profit. So follow through for the bulls on bar 6. If you bought above 5, 6 is what you want to see. And there's subtle details too. So if you bought below 3, let's look at it this way. If you bought below 3, what do you want to see, right? Probably a bull bar. But instead, you get a giant bear bar on 4. So if you bought below 3, are you ever happy with bar 4? No, you're really disappointed with bar 4. And then you get the high 2, and look where 6 closes. 6 closes above the 3 low, which means that the bulls who bought below here, they scaled in lower and it got back to their price, and they could have gotten out with a scale in profit, but they thought, well, no, this was a good setup. I think I'll buy more here instead of exiting. So a lot of times when it gets back to that 3 low, you'll find sellers because bulls bought there and they bought more lower, and they're obviously going to be disappointed in bar 4. You can't buy below 3 and not be disappointed in bar 4. And a lot of those traders will usually use this bounce to get out, but instead they said, well, I don't know, I think this is a pretty good buy, and they held. So that's really important that we closed above this low. Bad follow through on bar 7, a bear bar, but it's a double top. You could argue it's a head and shoulders top, 1, 2, 3, but it's not really a very good sell following consecutive bull bars. I'd rather wait. You can also see that bulls bought the 50% pullback of bar 5. They could have bought above it, but better risk reward buying 50% pullback. So traders bought, took a chance we were going to trigger, and we did. And side note, but your 2 to 1 ended up being up here, and that's one of the reasons why we got so much selling up there, because there's 3 pushes up, 1, 2, 3, and around the 2 to 1 of bulls risk. 8, an outside up bar. Okay bar for the bulls. It's not what the bears wanted to see, so that's good enough for the bulls. Probably going to hold. We're probably going at least a little bit higher here, and you get bad follow through on bar 9. An inside bar on bar 10. 9 was essentially a big low too, but really not very good. I'd rather be long. And a bull inside bar on bar 10. The problem with bar 10 is it could be 3 pushes up, 6, 8, and 10. But it's a pretty tight bull channel, so we might continue higher. 11 was trying to break out of the upside of the bull channel, but was obviously not able to do it. When you're getting a breakout above a channel, it's lower probability. So it was lower probability that we were going to end up getting some sort of big bounce here, because you don't usually get upside breakouts of channels. Additionally, you got a big gap up here, and you could have been buying above here for a second leg up, and this could be, your 1 pullback and then a complex second leg up. So that could be what was happening up here with all these sellers. And additionally, obviously breakout attempt above the channel. Big bear bar, but a doji bar on 11. Not really a very good sell. It's a double top. Bulls might start to exit below. You can see that's why some bulls bought the close, trying to get 12 to be a bull bar closing near its high. Instead, big tail on the top. So 12, micro double top with 11, bigger double top, 3, 12, and still a couple legs up. So really not ideal to be selling below here since this was a bull bar, but bulls will probably exit below it and maybe a couple points below it. And that's exactly what you get on 13. If you're long, you don't really want to be getting out down here. I thought you get out a point or 2 points below 12, and that was a pretty reasonable thing to do. But it was a couple legs up, and 12 is disappointing for the bulls. The bulls wanted a bull bar closing on its high so that they could think, it would be more likely they were going to get the breakout. And when they didn't get it, they just took their profit around 2 to 1 of their initial risk. And you can see that's pretty much exactly where we went to. If you're disappointed with 11 and disappointed with 12, you look at the close of 12 and you say, well, that's not what I wanted to see, and I can exit here with pretty much exactly 2 to 1 of my signal bar, so I'll just do that, and that's what's part of what's causing 13. An inside bar on 14, it's a low one short for the bears, but there's probably buyers below, probably sellers above. And big outside up on 15, but I thought if we were going to rally, we probably would have already done it. 15 is a really big bar. It looks like a trading range bar. This to me looks like a bull leg in a trading range and not a bull trend. Follow through on 16, but it's really, it's pretty much closing right at your entry price. This is not what you wanted to see if you bought above 15. You wanted to see a huge bull bar, and instead you got disappointment, 16. So that's why you get selling out of longs on 17. You could be long up here, but it's super dangerous to be long up here, and you have to be very fast to get out. And you get disappointment 17, as you can see. Bear bar closing near its low on 18. It's a wedge, 3, 11. You could look at it as a triangle or a wedge. Wedge probably isn't the super correct way to look at it, but that's just how I look at it. Because usually a wedge would be getting higher highs, and here we're getting lower highs. So some sort of morphed, truncated wedge maybe. But regardless, 18, a bear bar closing near its low. It's bar 18, a good time for a reversal. It's a credible sell below 18. But the bears have not really done anything all day, so I would rather wait and see what we get. You could take it, but if you take it, is 19 really what you want to see? Not exactly. If you sold 18, 19 just buys you some time, is the way that I look at it. If I sold 18, I wanted 19 to be something like a bigger version of 61, the big bear bar closing near its low. Maybe look something like 4. You know what I mean? You wanted a strong breakout down here, closing well below the moving average, but instead you got bar 19. Which isn't necessarily bad, but it overlaps 18 a lot. So, most traders looking to sell the pullback, not sell the low. And there's a small tail on the bottom as well. So, better to wait. And what are you waiting for? That becomes the question, right? Well, if you're short, or if you're not short and you want to get short, you want to see a bear bar closing near its low below the moving average. And that was pretty much my requirement for 20, is I wanted to see a bear bar closing on its low below the moving average, and then I would have been willing to sell. And instead, you got a bear bar with the tail on the bottom closing at the moving average, and that's not what you want. And bears see that, and they buy back shorts, and that's what's causing the bounce on 21. I don't know if this is where it went to, but I assume 22 went to around a 50% pullback. I haven't looked yet. So yeah, 22 around a 50% pullback. Not really a good buy above 21. It's, you triggered the high 120, but you're going to get sellers at a 50% pullback of after 4 straight bear bars. So they sell, they get a scalp down essentially. And down here, they know that the bears who sold down here are disappointed with how this went, because some bears saw the close hoping for a collapse and they don't get it. So those bears scale in higher at 50% and they're able to make money down here. But they know any trader who sold this is going to be disappointed in the bounce. They're going to exit. So that's causing the bounce on 22 and 23. 24, a doji bar. It's a double bottom with 21. It's an II pattern. So, we're in breakout mode, but I don't think that's really news to anybody. You can see through all of this that we're in breakout mode. You can see pretty much all the good signal bars for the most part are generally getting kind of bad follow through. They continued all day, just, good, kind of a good entry bar or a good signal bar here, bad follow through. 33, not the worst, but bad follow through. 46, okay follow through, then bad follow through. I didn't think that was a good buy. 61, okay follow through, then bad follow through. 56, bad follow through. So just a lot of bad follow through in general today. So breakout to the upside 25, but really not the best bar. If you bought above 24, are you ecstatic about 25? Not really. It's follow through, but there's something wrong with it, right? And that's the key of trading range days. The same thing with 26. It's follow through for the bulls. It's consecutive bull bars with one closing somewhat near its high, but they're smaller balls or there's smaller bars towards the top of the trading range, and there's big tails on each side of 24. So it's really not what you wanted to see. 27, disappointment. And now you're sitting here in this trade if you bought and you're staring at 27, and that's kind of a tough situation. We can easily sell off and test the 24 high. So it's really hard to stay long. And you can see we get bad follow through on 28 and then a bounce 29. Any bears who sold 27, disappointed 28, bounce 29 because they're exiting. An inside bar 30. This is just a tight trading range. This is a mess. A bull bar 31. Closing near its high, but look at, I need something convincing. I need, a good bull bar closing near its high. 32, a wedge top, maybe a sell, to be honest, but my big problem with 32 is we haven't had a bear bar closing below the moving average yet today. So I'm not really sure that I want to sell 32 and bet that we're about to get the first one when it's a bar like this with the tail on the bottom, big tail on the top, and a reversal up on 33. Do you buy above 33? I think you can. We have an open gap with this, obviously with yesterday's high. And, I think it's reasonable to think this is a triangle and we might try and get a measure move up. But you also have to be aware that this is a lower probability trade and you want really good follow through. And you don't really get it on 34. I would probably just obey my stop after 34. And you get doji bar on 35, and bulls really wanted to bull close on 35. But instead, you got a disappointment bar like a doji. I think if you get any sort of bear close 35, a lot of times you probably just end up getting a dump because bulls, one bear close is kind of okay. But 2 bear closes is not what you want to see here. You don't want to see any sort of consecutive bear closes after buying into something like this. But we instead get a doji, which is, minimum follow through. You could argue minimum follow through for the bears who sold 34, but it's just a mess. You can see what I'm saying is confusing because it is confusing because it's trading range. A move up 36 and a breakout of the 18 bar range, but I don't really know how much higher I think we're going to go. We need, bulls need good follow through and they need it now. The next side to get a good close and a convincing bar is going to probably be the side that wins this. And then, we get 37, a big bear bar closing near its low, a failed breakout of the 18 bar range, potentially some kind of wedge, and just a reasonable sell outside down. The problem with it is 36 is your signal bar since it was outside down, but the big problem is you're selling near the moving average on a day where you have not had close below the moving average yet today. So bulls are probably going to try to buy the moving average the first time, and that's why you get a doji on 38. Outside down on 39, but it doesn't close below 38. If you're selling below any of these, you really wanted to see 39 break out below 38 and close down there, and it didn't end up doing that, and that's pretty disappointing. 40, it's a high 2, high 1, high 2, but this bear channel from this 4-bar bear channel is essentially pretty tight. I wouldn't buy above 40. I'd rather wait. A gap bar trade like this is something you want on a trend day, and this is just a trading range. Take out the moving average. Forget the moving average exists for a second. What are you really doing if you're buying here? You're buying in the middle of a trading range after, a decently tight bear channel. It's really not very good. Follow through on 43 for the bulls, but really not, anything to write home about. I think really you're just going to probably find sellers. Maybe you're selling, maybe it's a 50% pullback, which is pretty common in trading range days for traders to sell 50% pullbacks. 42, a doji bar, midday, you could argue some sort of reversal, trend line break, pullback, major trend reversal, but it's a doji bar, so you don't really want to sell. And a big bear bar, 43. This is what trading ranges do. They try to trap you out, and then you get big but slightly disappointing bars in your direction. 44, an inside bar, a low one short, but doesn't close near its low. And traders who were selling for any reason were hoping 44 would close near its low and potentially create a swing sell down to yesterday's high. But instead, just a disappointing doji bar. Bounce on 45 from traders buying back shorts. And you can see we touched the 42 low since the bulls who bought below 42 and scaled in lower were most likely to get out around break even if we're likely to be given a chance to get out. Why? Because it's trading range day. And on trading range days, traders are able to do that. And same thing with 3. If you bought below 3, you see how it closed up here, which was good for the bulls? Well, look here. If you bought below 42, how do you feel about 43? Obviously disappointed. And when you get the bounce, the traders sold it on 45. So that's what happened there. 46, a low one short. I think it's okay, actually, to be honest, for always in traders. It's a decently tight bear channel. You'll probably get bad follow through, but it's always in short in a bear bar closing near its low. So it's probably kind of okay. Follow through on 47, but doesn't close below the breakout point, the 43 low. And disappointment, 48. A bear bar closing near its low, 49, and it breaks out of the low, but never able to trigger. Could be some sort of wedge forming, 40, 43, I don't know, maybe 49. So disappointment. 50, closing near its high, good bull bar, potential wedge, but this is a pretty tight bear channel. I don't think I want to buy above 50. I'd rather see what we get. And even 51, you don't really want to buy above 51. It's a bull bar, but it's not like a great bull bar. It's a smaller bull bar. It closes near its high, but you wanted to see a really good follow through bar. If you're buying in a tight bear channel, you want to see something exceptional that makes you, surprised. You want a surprise essentially if you're buying here and you don't get it. So traders quick to get out, and that's what causes 52, big bear bar. Surprise bar down, probably enough for a second leg. Follow through 53, so, still a surprise bar, still enough for a second leg. And you can see we did end up getting a failed breakout of this side of the 18 bar range and a breakout of the other side of the 18 bar range. So more follow through 54, but a doji bar. Look at this breakout. Is it really, is it all that ideal? If you're short, it's still an okay breakout, but a big tail on 52. I suppose I don't need to be over here, but a big tail on 52, big tails on either side of 53, and an inside bar with a tail on 54. So is this a great breakout? No, it's an okay breakout, but it's exactly what you get on trading range days. There's something wrong with everything. It's a trading range day, so traders are going to scalp. An outside bar, 55, outside up, but not worth buying. Potential wedge, but after 3 straight bear bars, I would rather not do it. Outside down, 56. It's an 00, so for always in, it's probably credible. But I'm not, it's a bear bar closing near its low and it's always in short. So it's going to be an okay sell, but potentially a channel line overshoot of some kind, maybe not as good as it could be. And you can see we got disappointment on 57, but a bear bar closing around its midpoint. And a lot of times on 58, you get another big bear bar, but this time you can see when 58 traded back down towards the 56 close, bears got out instead of getting back in. It's essentially an II 57, 58, but probably not all that good to buy above. And a bear bar closing near its low, 59. So why doesn't 59 trigger? What's going on here? Well, there are 2 theories. Both are correct. I would say the first one is that the bulls who bought above 58 are disappointed in 59, but they don't want it to trigger. So what they're going to do is they're going to buy the market right here with a stop 1 tick below, and they're risking 2 or 3 ticks trying to make, maybe a couple of points. I would say the second theory is the bears who sold below 56. If you're selling below 56, they know it's a trading range day. They know it's probably going to come back to their entry price. So they might sell more above 56. And if you sold below 56 and you sold more above 56, you can see the close of 60 or 59 is almost exactly where your entry price would be. And that's your average entry price. And those traders sold here. This is relatively disappointing. And again, there was a bull bar closing near its high at one point when it was up here when they sold. So this was all relatively disappointing, and they get out, and that causes the bounce on 60. 61 closing near its low. It's essentially a low one below 60, but good follow through on 61. Bear bar closing near its low. Sellers at the moving average. Again, on trading range days, traders sell the moving average a lot. So sellers at the EMA and a good bear bar closing near its low. Probably reasonable sell, looking to get to yesterday's high. But again, kind of a disappointing bar 62, and you're hoping for good follow through 63, but you don't get it. Traders exit, maybe 5 points, maybe 6 points, whatever. I would imagine most traders would have scalped that with 5. Reversal up on 63. It's a channel line overshoot, so it's not the worst buy in the world, but you're not buying 63 and sitting on your hands. If you're buying above 63, you get disappointed in 64. Oops. You get disappointed in 64 and you're just exiting during 65. So that's why this bounce up here just got sold, because traders exited during 65. But hard to sell 65, a doji bar, and a big tail 66, an inside bar, a doji bar 67, micro double bottom here and a bigger double bottom. But I wouldn't want to do anything. I think at this point in the day, bears have had a couple of chances. This was a chance to really sell off to down here. This was a chance to really sell off to down here. And they failed both times. So I think that, for the most part, bears are going to give up and just look to make the market be sideways for the remainder of the day. And that's basically what happened. So I think once you get 68, assume it's probably going back to the 60 low, right? You buy the 60 low, you're disappointed in this. You're probably going to be able to get out, and that's what happened. But I just think this was all very disappointing. Look at this. Even if you bought below 50, which was probably reasonable, and you scaled in lower, you tried to get out at 60, but you couldn't. You kept scaling in lower. You got out 73. That's why there were so many sellers here, because there were bulls who bought the breakout below the wedge, right? 1, 2, 3. They bought the breakout below, and they scaled in all the way, and they got out. So, but that's really difficult to do. It's really difficult. It's near impossible to look at 61 and think, yeah, I think I'll buy more. I think I'll buy more lower. To me, that just seems like a recipe to get trapped when you're already kind of trapped. Which is why I don't trade on limit orders, because it's really hard. So for stop orders, 5 was probably the best of the day. 6, a good follow through. You could buy that. You could probably buy 10, but you got to be fast to get out. You probably sell 18, but you probably got to get out above 21. I'd rather wait for follow through. I wouldn't sell 19 or 20. You probably buy 33, probably sell 37. But if you're selling 37, it's really pretty much impossible to just sit through all of this. It's really hard to do. You could probably sell 46. I think you can sell 56 because it's an OO, which is it's sell below, but I don't know. You can sell 61, you can probably buy 63, but quick to get out. On the daily chart, we had a big overshoot, you can see, of the channel line. And so I'll say the same thing I've said probably like 100 times on this whole rally. I'm expecting something disappointing for the bulls. We got something disappointing for the bulls. So I would say 30% chance that we start to get a breakout below this tomorrow, and we just get a big bear bar and bulls just dump out of their long. So I would say maybe 30% chance we get a big bear trend day tomorrow, maybe slightly higher. But I wouldn't say much more than that. And you just get a ton of, this is a great area. If you bought anywhere in here and you get this big gap up and there's risk below here, it just makes sense to get out down here. It just seems like a gift. It seems like a gift for the bulls, this price. So that's what I'm getting at. It seems like 30% chance we get a big drop. Weekly chart, very climactic for the bulls. We'll see if it can close that way tomorrow. And we're closing up the month, and this is insanely impressive. This was really unusual. I did not think this was going to happen. Even after this pair of bull bars, I thought we were going to get something disappointing. And we kind of started to, but then this was a very surprising bar in February, and we're getting an even bigger surprise in March. So, I think we'll hit 6,000 before we hit 4,000, but I think we'll hit 5,000 before we hit 6,000. And yeah,